Futures searching for some direction this morning. 60-point gain on the Dow. Futures markets close at 1 p.m. Eastern time this afternoon. If you take a look at the yield curve and the difference between the 2-year and the 10-year Treasury yield, with the 2-year being at almost 4.5%, the 10-year at 3.7%, that inversion is the widest it's been in 22 years. Joining me now, Raymond James, investment head of Advisory Solutions and Market Strategy, Matt Orton. Matt, that says recession, does it not?
Good morning. Typically, when you have an inverted yield curve, especially for the amount of time that we've been inverted, it generally means that there's going to be a recession ahead. However, what I talk to a lot of our clients about is, what does that recession actually look like? Is it going to be a severe recession, or is it going to be something a little more mild? And in my opinion, the good news is it's going to be a little bit more mild, and the equity markets, which is what a lot of our clients are focused on, how does that impact the equity market? Likely we've baked in a lot of the worst moves. So there's certainly a lot of opportunities going forward, but that's why I like to remind our clients to remain defensive. Lean into healthcare, lean into higher quality companies that are paying dividends and actually generating cash.
Well, the NASDAQ's down almost 28% year to date. The Dow is not even down 6%. How's that baking in a recession, Matt?
So we've had a lot of gains coming off of the lows that we had at the end of September, early October. But a run-of-the-mill recession generally means on the S&P 500, you're down around 24%, looking at past history over the last 50 years. So we've already been there. We've been down more than 24% at the lows. And so particularly in certain technology industries that are down 25, 30, 40+% so far this year, they're baking in higher yields. They're baking in more difficult conditions to come. But that's also why areas like small cap equities, for example, smaller companies that are more leveraged to the U.S. economy, they're baking in even more than a run-of-the-mill recession, which is why I think if you want to catch up with the market and complement a more defensive positioning for your portfolio, small cap equities make a lot of sense, because I like to say they're discounted for despair at this point.
John Lonsky, jump in here. Does the market have it wrong? And does the GDP now out of the Atlanta Fed have it wrong? When you were talking about this to me in the break, they're expecting growth of almost 5% for the GDP in the fourth quarter, right?
Yeah, that's 5% for real consumer spending, 4.8%. I think that's ridiculously high. What they're suggesting, you will have an extraordinarily robust holiday shopping season. I don't think that's going to be the case. I think GDP now is wrong. Their GDP forecast is 4.3%, and even that's over the top. I think the market also may be wrong in that they are too dismissive of all the uncertainties and risks that will suddenly come to the surface once recession strikes. Remember, recession involves a material weakening of the labor market. We're going to begin to see payroll shrink. We'll also see the unemployment rate perhaps rise by as much as 1 percentage point. It's during that phase where the economy begins to contract that investors get worried and will observe a renewed downturn by equity prices. I don't think equities will form a definitive bottom until we're actually in the next recession.
Matt?
Yeah, I don't disagree with any of that. And that's one of the reasons why I've been so vocal about keeping a core defensive bias. There's a lot of folks out there that want to get excited that the V bottom has been put into the markets and that we're going to rally into the year end. We certainly could rally into the end of the year because there's a lot of strong momentum behind the rally that we're having. But that doesn't negate the fact that there are going to be more challenging times ahead. And that's why leaning into sectors where you're getting dividend growth, where you have higher quality companies with positive free cash flow, those are the types of companies I want to own. And that's why I think healthcare, even energy to some degree, because oil prices are fairly well supported. These companies are throwing off incredible margins, paying dividends, returning cash to shareholders. Those are the types of companies that I want to own in a market where there is a lot of uncertainty going forward. But all isn't lost, and there are reasons to be optimistic, and there are parts of the market that have been working.
Matt, thank you so much for being here. I'll say one thing about, investors very excited that the Federal Reserve looks like it's going to slow down on the interest rate increases. But with Joe Biden signing off on an extension of the moratorium on making student loan payments, that is wildly stimulative to inflation. And I don't think that anybody has really started thinking about the tens of billions of dollars that will continue to go into the economy. It's like $400 or more per month in stimulus checks that's handed out to millions of people, including rich folks, doctors, lawyers, investment bankers, and the like. And that just makes the Federal Reserve's job that much harder. But I'll leave it at that. Matt, thank you so much. Matt Orton.